that comes with lending activities. So a typical credit process will go through: the customer applies, which I guess we are all familiar with. I'm sure a lot of people have gone through that process in terms of applying for a loan, either digitally or through a paper form. But what comes with that from a bank perspective? It's possible that the information provided on that form is incomplete or inaccurate. It has happened, it happens, and it will continue to happen. So that's a risk inherent in that process. Then it needs to now assess the customer, whether he's able to pay or not. You need to underwrite the risk itself. Then you need to disburse funds. Another risk evolves from that particular process. Are you disbursing funds to the right person? Is the account, has adequate KYC been done on the accounts before you actually disburse funds? The individual itself, does he have the character to actually be granted that credit facility? Then you've gone through that process, you decide, okay, you're dealing with the right person, KYC is okay, the information provided is okay, we disburse funds. The next process from a bank's perspective that you need to monitor, like I said earlier on, these are depositors' funds. So beyond just disbursing the funds, you're now beginning to monitor that the purpose for which the loans were granted is what it's being used for, and that those repayments are coming in as and when due. But the reality is that in Nigeria today and most developing economies, the credit culture is still maturing, right? Which takes me back to the point around banks don't want to lend. Banks have had their fingers burnt over the years, either from inappropriate credit practices and also credit default. So that credit monitoring process is very critical from a bank's perspective. And of course, you have issues around customers missing payment, or customers from the onset, when those loans were being applied for, never had the mindset to actually repay those loans. It has happened, it happens, and it still continues to happen. It's unfortunate, but that's where we are today. Or then, of course, if the payment doesn't happen, the banks then need to chase recovery. That's a difficult part of the process, but then it needs to happen. Like I said earlier on, it's not the bank's money, it's depositors' funds. And I think over the years, I think recently with the advent of social media, I think there have been a lot of videos about people from the banks going to relay customers at home and recover their funds. It's unfortunate, but we just do all the things we need to do to make sure that we can recover the depositors' funds. And I think what happens that most people don't know about is the support that goes within that process. So before the credit recovery starts, they will have an effort to support the customer or the business to either regenerate the business so that they can make their repayment terms, but that doesn't happen. Then, of course, the banks get exposed to reputational damage when they now take steps to recover their loans. And, of course, we need to look at our portfolio across board in terms of diversification and in terms of concentration risk and what is happening in macroeconomic space. So there are regulatory and prudential guidelines that banks need to comply with. And these are things that we need to monitor as well to be sure that we don't roll foul of what is going on. So we look at this process itself. It looks simple, but trust me, it can be very complicated, and it has risk all over the place that banks need to effectively manage. Next slide, please. Okay, so what are the lessons that banks have learned in the past? So typically, before you grant a credit, look at five things, basically, which we call 5 credits for those that are familiar with the credit process. We look at the character of the borrower. We look about the capacity of the borrower itself. Is he able to repay the loan? We look at the collateral itself, whether in the event of default, there's enough collateral to recover depositors' funds. We look at capital as well, and we look at regulatory changes, conditions in terms of regulatory changes. So I'll speak a little bit about some of these things. Character. I talked about the fact around the credit culture in our current environment. And what other challenges we see around character is around limited credit history. So of recent, there's been some progress which has been driven by CBN, where before you give loans, you have to do some credit checks. So that's helped manage that that particular challenge. Then capacity. And that's where the debate comes in about whether banks are willing to lend or whether they're not willing to lend. So in a lot of instances, you have customers that just don't have the capacity but actually need those loans. So that these are things that has happened and banks have got their fingers burnt. Collateral, document forgeries happens, which we need to manage as well. And then, of course, regulatory changes. There are frequent changes happening in the regulatory space. There are regulatory guidelines that we need to meet as banks, and those are things that give us challenges in that respect as well. So a lot of lessons have been led by banks, and this is an area that we continue to look at ways to make it more seamless for customers, given the fact that the credit process or lending itself plays a very key role in economic development. So I'll go to AI and what is happening in the lending space. If you go to the next slide. So what are we beginning to see in terms of artificial intelligence and lending? So things are actually evolving. So look at credit scoring. So what typically happens is that before you give out the credit, you want to assess the customer. And what you do in assessing the customer is to give a score to the customer. So in the past, it was a little bit subjective. But now we are seeing credit scoring models being developed. So if you look at Zest Finance, for instance, they use machine learning to analyze thousands of data points to assess whether the customer is the right person to give loans to. Credit tech employs AI to assess credit worthiness, looking at online behavior and social media data. So beyond the things you put on your form, either digitally or manually, there's an AI algorithm that actually looks at all your footprints socially to determine whether you need to be available of credit. Where do you spend your money on? What is your lifestyle? Do you gamble? Do you bet? Those are risk indicators that are factored in that are brought in from your social media footprint, and that helps in assessing whether this is the right person to grant credit. Bank of America uses AI to provide personalized financial advice to customers. So you can analyze your bills. How much are you spending on your monthly bills? What are you spending it on? And based on that, they can help that in terms of whether they need to lend to you or not. Other similar companies are using OCR to automate document verification. I talked about forgery of documents initially. So imagine trying to go through several documents and thousands of customer applications to find out what are genuine or not. This has been automated using AI, where you're just scanning the documents using OCR technology. And then you can quickly fish out forgeries and things that don't align or are inconsistent within those documents. So things are evolving rapidly around the use of AI and lending. And what does that really mean? It means that banks are able to take more informed credit decisions on those depositors' funds that are being available to customers. And when banks are able to make more informed decisions on this credit, the risk is managed. The non-performing loans reduce, and then the banks are in a position to lend more and stimulate the economy. So the impact on AI, on lending, and overall economic growth cannot be overemphasized. That is the future of lending. That is the future of everything that's going to happen going forward. Then lastly, in conclusion, what is the way forward? Lenders must adopt AI for improved risk management practices. That is the way forward. That is the only sustainable way for banks to grow their credit portfolio. Because you need to grow, and where to grow, if you want to diversify your risk, is a retail banking, retail customer space. And there are volumes of customer applications in that space, and you need to use AI to automate the process, make more informed decisions, and drive efficiency. Data utilization, analyzing the data within our systems to identify what loans to give out, to who, and when there are indications that that credit or facility may go bad. Regulatory compliance, there's a whole lot of regulations happening in banking and in lending in particular. So for us to stay updated, we need to use the RegTech solutions to monitor compliance as we go about our lending activities. I think Mrs. Abraham spoke earlier on about data security. So as we use data to support our credit decisions, as we use AI, as we use technology, there's a whole lot of risk that is inherent in that process. I think recently, over the last couple of weeks, there's been a lot of noise around fraudsters and the impact of the quantum of fraud in the banking industry. It all comes back to the issue around how do we secure our data, right? So for this AI to work, for us to use data, we need to be sure that the risk inherent in terms of data security, in terms of cyber security, have been well managed. Skills development, we're all aware of this JAPA syndrome. It has an impact, right? We're talking about AI, data analytics. We need people with the right skills to drive that agenda, right? But we have a situation where a lot of people, a lot of key skilled people are leaving the country. It has implications on how much or how quickly we can drive the AI agenda. So skills development is critical. Strategic partnership, right? So the way I look at AI lending or any human endeavor, it has to be collaborative. No single player or entity can deal or move things forward. So it's important we have those strategic partnerships, not just locally with other banks and fintechs or technology providers, but across the globe, for us to be able to harness the powers of